the most talked about thing, I think that everybody's followed for the last whatever year and a half is Fed policy. So it's like every time there's a meeting, it's just it's pins and needles, and everybody's waiting, and the market reacts. So I think for a while it was higher for longer. I mean, in your view, does that still hold true? Yeah, and you talked about it a little bit, because one of the things with inflation is there's 18 different ways to measure it, and everybody takes out what they want to take out and put in what they want to put in. But you guys pretty much look at the overall inflation basket, including energy, including housing. I can't remember the one I saw, but somebody said that inflation was, again, this is one of those political spins, right? Inflation was way down, but they took out everything that was up. It was energy. How everything that was up had been taken out of their calculation. They called it some different type of inflation measure.
And that's part of the challenge. There are many Federal Reserve banks located around the country. Each of them has their own measure of inflation, looking at median prices, looking at, their estimate of sticky prices versus non-sticky prices. The New York Fed has this crazy econometric model that they run to try to kind of distill the underlying trends in the inflation data. But I think at the end of the day, when you listen to what the Fed and other central banks say, is that they recognize that food and energy prices cause volatility and headline inflation, but people spend money on food. People spend money on gas. And so you can't just strip all this stuff out. It's like people like to strip out shelter in the current environment. It's like, well, a lot of people need to pay for some place to live. So in theory, right, that is still a consumer expenditure and should be included in the inflation calculation, even if you don't like the way that the Bureau of Labor Statistics comes up with that data point.
Right. So I guess on inflation, then that obviously is very tightly correlated with economic growth and the outlook. Do you have thoughts there?
So, again, I think 50-50 in 2024 on recession, leaning more into the idea of a soft landing. The economy just has more momentum than I think anybody predicted. And, as somebody who's done macro research for almost a decade and a half, I can tell you that the models haven't worked as well over the past few years as they did prior to the pandemic. On the recession question,
why is that, you think? Why have the models not worked as well prior to the pandemic?
So a lot of the models are based on kind of long-term trends and more stability in the data. And if you think about what has happened since COVID, macroeconomic volatility has been very high, right? The growth numbers bounce around a lot. The inflation numbers have bounced around a lot. And that's made distilling any sort of trend from the data, which is really what econometric models do at the end of the day, all that much more difficult. So there's definitely been a technical headwind to getting the forecasting right.
Sorry, do you think that has to do with a little bit of the basically government intervention? That we talk about this a lot, that hey, if you were in Econ 101, right, you got supply and demand, and it's a pretty simple model. But then when you have these artificial forces like government intervention, all the models break down. I was wondering if that's sort of part of it.
Yeah, I mean, I think that's a piece of the puzzle. Obviously, injecting trillions of dollars of stimulus into an economy is something that we don't have a whole lot of experience doing, right? And that's probably a good thing rather than a not so good thing. But also, just if we go back to 2020, and we were chatting earlier about the conversation we had back in April of 2020. I mean, that was the shortest recession on record, right? The economy basically stopped overnight, and then a few months later started back up. Like, I think we'll never see anything like that in our careers, in the remainder of our careers. And so part of it, yes, has to do with the government response and all of the fiscal spending, but part of it also just has to do with the nature of a pandemic induced recession, right? Which is not necessarily what you see on average over time.
Hey, David, do you think if we do get pushed out to 2025 potentially, and I mean, really, who knows? This is a little difficult to forecast that far. Would the tail of the inverted yield curve still be in play, the 2 and 10 or the 90-day and 10, or would this be the one that it doesn't work as far as the tail for economic slowdown?
So the yield curve has sounded some false alarms in the past, right? It's not a perfect indicator of recession. I think the bigger takeaway, though, is that it's pretty good, right? And it tends to hit more than it tends to miss. The big question is about the timing from inversion to recession. And if you look over time, it's the average is kind of 12 to 15 months. But if you look at the distribution of that, it can be as short as a couple of months or as long as a year and a half. And so I think that the validity of the indicator still very much holds. My bigger question is what happens to the labor market going forward, and can the Fed, do what they've said they want to do, which is effectively destroy job openings without destroying actual jobs. To me, that's the $1 million question when it comes to the outlook for whether or not we have a recession. And then the one thing I did want to add earlier on the recession question is that a lot of people, when they hear the R word, they immediately think 2008, they think 2020, right? Recency bias can be your worst enemy. When we look at the cyclical parts of the economy, which really can inform a view on the potential magnitude of any drawdown and subsequent rebound in economic growth, nothing really looks offsides. And so you look at investment spending, you look at housing, you look at autos, you look at inventories, and everything's kind of in line with its long run average. And so, if we do have a recession at some point here in the next, call it 18 or so months, we don't think it would be particularly outsized, right? We think it would be more in line with what we've seen on average since World War II.
Interesting. And so in view, probably the most talked about thing, I think that everybody's followed for the last, whatever year and a half is Fed policy. So, it's like every time there's a meeting, it's just, it's pins and needles and everybody's waiting and the market reacts. So I think, for a while it was higher for longer. I mean, in your view, does that still hold true?
So here's the way I think about the Fed. If you look at what the forecasts are, so the Fed's own forecasts, then we'll get a new set of them in about 4 weeks here. The Fed's own forecasts are calling for 2 25 basis point cuts in 2024. The market is pricing in 4 25 basis point cuts in 2024. The way that I think about it is if we don't go into recession, why would the Fed cut for the sake of cutting? I mean, if we go back to the post-COVID or the post-GFC environment, right, we spent 10 years talking about the Fed needing to get rates off of the bottom so that they had something to cut when the economy hit the skids. And you're going to tell me that they're going to cut when the economy's okay? Maybe they ease ever so slightly, but I don't really see that playing out. What I think would get them to cut is if we have a recession. And so to me, the outcome is very binary, where we're either in this environment where rates stay higher for longer, or the plane crashes at some point in 2024 and the Fed responds aggressively vis-a-vis the interest rate channel. But the idea of modest cuts next year, I just don't really buy into that. So I would say still leaning into higher for longer at the end of the day.